Hey, welcome back once again, options traders. It's been a while, and I'm definitely trying to get back on track to posting videos for everyone. But I received a very good question from one of the traders in our group asking about some steps for writing covered calls. And like most option strategies, there's a lot of stuff to consider. It's really hard to whittle it down into saying, here are the steps to do. But let me at least try to give you some of the key points to consider when you're writing covered calls. So let's go find out what these steps are. And as always, please be sure to click like and subscribe. It is truly appreciated and definitely helps to promote the channel. So as a reminder for the covered call, you're going to buy 100 shares, or perhaps you already have the shares in the account, that's fine, and you will sell a call against it. And when you do, you have the obligation to sell those shares for that strike. Now remember, it's a potential obligation because it's up to the call buyer to make that determination. Sometimes traders think that when they sell this call that they're guaranteed to sell for that strike, and that would just be way too good to be true. So always remember it's a potential obligation to sell the shares for the strike. Also, these are done in a 1-to-1 ratio. And what that means is that if you own 100 shares, you could sell one call. If you own 500 shares, you could sell up to 5 calls. Sometimes new traders think that if they have 500 shares, they have to sell against the entire lot, and that is simply not true. You could own 500 shares and sell 2 calls, which really breaks down to that you would own 300 shares and have 2 covered calls. But just remember that you don't want to write more calls than what you have in shares, otherwise you end up with some naked call positions. Now, when you sell this call, you are going to reduce your gains, and that's because you're giving up the unlimited upside potential gains of the stock. But the reason that you're writing the call is to reduce the risk. It's the downside. That's the main reason for the covered call. Now, also keep in mind that the amount you have at risk is the current market price. This is incredibly important. Sometimes traders will say, oh, I bought stock at 30, let's say, a fairly cheap stock. I've been writing calls against it for years, and now I've got this negative cost basis. I've paid 30 for the shares and I've written $35 worth of calls. Now I can't lose. Well, that's just not at all true. What if that stock is trading for 200 bucks? Are you going to say you've got no risk? So always remember, whenever you're deciding on which strike and expiration, which we'll talk about in a little bit, you always must guard the current market value of those shares, not the cost basis. So another thing to keep in mind is that, let's say these are your 100 shares purchased at 100 or with a current market price of 100. If you sell the 95 strike, you might move from the black to the green. If you sell the 100 strike, you might look like this. And if you sell the 105 strike, you might look like this. And the main thing to see is that they are all trade-offs in risk and reward. You cannot say that one strike or expiration is better. So if we sell the 95 call because it's in the money, we don't have room for a lot of profit. But we do have a much bigger downside hedge. Notice how this green line sits the furthest to the left. We can afford to have the stock fall by a larger amount and just break even. If we sell the at the money, the 100, we allow for some more profit, but we give up some of the downside. Now that green line is pushed to the right a little bit to the blue. And if we sell an out of the money call like the 105, now we've got the room for the most gains, but relatively speaking, we have a very small downside hedge. So this is really where the decision comes down to. What are you trying to do? What are your goals? How much of a hedge do you need or desire versus how much profit do you desire? And it's so important to start with this, with a goal, because if you don't, you're always going to be tempted to write the furthest out of the money call that you can for no money. You've got no downside hedge just because you're focusing on this potentially large gain. Well, if that has nothing to do with your goals, then it's just not a good idea. Generally speaking, you want to try to write something close to at the money, maybe a little bit in or a little bit out of the money. Of course, it depends on volatility, but you definitely have to be very careful of writing it so far out of the money that you're just giving yourself no downside hedge. Remember, the downside hedge is the main reason for using a covered call. Now, in all of these cases, you'll see that we have a flattened off region above the strike, regardless of the strike. You're going to reach a point where you're just not participating in the movement of that stock. And because of that, a covered call must absolutely underperform the broad-based market in the long run. Now, if you don't believe that, you can go check out the CBOE, the Chicago Board Options Exchange Buy Right Index, which is under the ticker BXM. So the buy right index, same as a covered call, it just means you're buying the stock and writing the call or selling the call. And what it does is it shows the hypothetical performance of a portfolio that continually writes 30-day calls. Now there's some specifics. It's usually just out of the money. They write it all the way into expiration, settle for cash, and then write a new one. But the thing to see if you compare it to the S&P 500, that in the long run, the covered calls will absolutely underperform the broad-based market. So you have to be careful about this before you start writing covered calls. If you're willing to hold that downside and looking for long-term gains, you might be better off not writing calls or maybe doing partial writes, owning 500 shares and selling 2 or 3 calls. So once again, this is just to emphasize that the main reason for writing the calls is the downside hedge. Okay, so on to the next topic that we have to be aware of. I've talked about this in many videos, but it's super critical for covered call writers, and that is the square root pricing rule. So as a quick recap here, remember what this means, is that it takes about 4 times the amount of time to double an option's price. And this applies for the at-the-money options only. And the reason for this odd relationship is that option prices are proportional to volatility, and volatility is proportional to the square root of time. So here's what this means. If you have a 1-month option trading for $1, what's the 4-month option worth? Well, the way that we figure it out is we look at the relationship in time here. There's 4 times the amount of time between these options. But that doesn't mean that this price is going to be 4 times as much. Instead, we take the square root of this, square root of 4 is 2, and that means that over here we're going to have a pricing relationship that's double. So if this option costs $1, the 4-month option would be 2 times that, or $2. If the 1-month option is trading for 3, the 4-month option would be trading for about 6. So why is this pricing relationship important? Well, a lot of times covered call writers hear that the shorter term options provide larger rates of return. In other words, you're getting $3 per month here, but if you're getting $6 over a 4-month period, that's only $1.50 per month. It's half as much. And because of that, they tend to always think that the only way to write covered calls is to write the shortest thing possible, even if it's 3 days or 5 days, because you're getting the most per unit of time. And that's partly true, but we have to remember that the covered call is always about the downside hedge. And if you're selling off really short-term options for 30 cents, you're just not doing yourself any favors, and yet you're still completely capping off the upside. So a lot of times, even though they might not be the highest per unit of time, I will look for 30 or 45-day options, maybe even 60-day options, and write those because at least you get larger downside hedges. So just keep this in mind. Yes, if you've heard that, it is true that you're going to get more money per unit of time, but it's a complete misperception to think that the only thing you should ever write is a super short-dated option, especially when it's just not worth a whole lot. So the next thing to understand are your return calculations. This is going to come into your decisions. There are 3 main ones to understand. There's a static return, a return if exercised, and a break-even return. So here's some examples. Let's say that we buy shares for 100 and we sell the 30-day 105 call for 2. So this is 5 points out of the money, and let's step through these 3 different returns. The static return assumes the stock price remains the same at expiration. So if the stock is 100, that's what we spent for it, and we sell the 30-day 105 call for 2, our effective cost is $98. Now, if the stock sits still and is still trading for 100, the stock trader makes a 0% return. But what's the static return for us? Well, we have a $2 gain for a $98 outlay. So 2 over 98 is just over 2%. Now, because this is a 30-day option, if we annualize that, multiply it by 12, that's a little over 24% per year. So if this is in line with your goals, then that would be a nice choice. So the static return shows that we are able to make some kind of a gain even if the stock sits still. What about the return if exercised? Well, this assumes that the long position exercises, or in other words, you get assigned. So let's go back to our stock at 100. We sell the 30-day 105 call for 2. Cost basis is 98. This time we get assigned. And that means that the stock goes up through the 105 strike. We never roll it. We don't close it. We just take the assignment and we sell our shares for 105. So the stock trader would make a 5% return, buying stock at 100 and selling at 105. What's our return if exercised? Well, we made a $7 gain for $98 down. And that's because we paid 98 and we sell for 105. That's a $7 gain for a $98 cash outlay. That's a touch over 7% or 85% annualized. Now again, the stock trader would make 5%. You're picking up another 2 percentage points. And that's coming from this options premium right here. And this is where covered call writing can really compound your efforts. And it might not seem like a lot, but these extra couple of percentage points goes a long way over the long run, especially when you consider compounding. But as before, if your goal is not trying to get 85% return, then maybe we shouldn't be selling the out-of-the-money call. Maybe we should sell something closer to at the money, get a bigger premium, and therefore a bigger downside hedge. It's all part of the steps that you have to consider. Now finally, what is the break-even return? This assumes that you just break even. This really focuses on the downside hedge. So again, we're going to use our stock at 100. We sell this 30-day 105 call for 2. Cost basis is 98. If the stock falls to 98, then the stock trader is down 2%. But our break-even return, notice that we can afford to have it fall $2 because we collected $2. So we can afford to have the stock fall $2 relative to the 100 price, which is where it was when we sold this call. So we could afford to have it fall 2%. So we have a 2% downside hedge, and we would just break even. But our stock trader would be down 2%. So this trader is going to need more than a 2% move in the future just to get back to even. And we're already at even. And that's because we have this nice downside hedge. This emphasizes why it's so important to focus on the downside hedge. So the main thing to understand about a covered call is that it's about balance. Don't sell a call so far out of the money that you're not receiving much money. There's no downside hedge. And by the same token, don't sell a call so deep in the money that it's behaving about like a T-bill. Get a good blend of downside protection and returns. If a certain strike doesn't bring in the required premium, then sell a longer dated option. There's nothing wrong with that. Don't fall into that trap of where everybody thinks you got to sell the weekly option. If it's not bringing in the right premium, but there's a certain strike that you like, keep going out in time until you find that right relationship. So now with these key points in mind, let's take a look at some simple steps when you're writing the call. Step number 1, determine the amount that you're trying to make for the period. Period being the next month or the year, whatever it happens to be. We also have to consider the risk. Is it a high volatility stock? Do we have a lot of money into it? And as a reminder, the amount that we have at risk is the current market price. Doesn't matter if you paid $30 for the shares. If they're trading for $200, we have to guard the $200 price. So if you're into a situation where the risk is high, whether it's because it's high volatility or maybe just an expensive stock now, consider in-the-money strikes. In-the-money strikes maintain greater hedges, and that's because there's a certain amount of intrinsic value that will not bleed away. So for example, here are some prices from a pricing model. Here's our at-the-money $100 call. But notice if we go 5 points out, $5 out of the money, that call is worth about $1.56. If we go 5 points in the money, we have roughly $1.56 of extrinsic value, but we've got a $6.42 downside hedge. See, if we sell the out of the money, we've just got the extrinsic value as the downside hedge. If we sell the 110 call, we only collect 60 cents, and that's the size of our hedge. But if I go 10 points in the money, I have roughly 60 cents. I've got 43 cents. But those pricing relationships are going to stay roughly equal, whether we're looking 10 points in or 10 points out of the money. But I've also got an extra 10 points of intrinsic value. So notice that if you sell the 110 call and it starts to decay, yeah, you might have a 60-cent hedge today, but next week it's not going to be 60 cents. That hedge is only as good as its starting value on that day. But this one is never going to lose that intrinsic value unless the stock price falls. It's not going to decay away, that $10 intrinsic value right there. So this is why when you're considering which strikes to write, think about it. If you can get a decent extrinsic value, because remember that's all you're making. So remember, if you sell this $90 call, you're only making the extrinsic value, or 43 cents. So this is why I said earlier, don't go so deep in the money. Let's say to the $80 call that's trading for 20.01. It's going to behave like a T-bill. That's almost a synthetic sale of your shares. It's giving you a nice downside hedge, but you also have no reward. So we want to find a nice blend. But again, consider going in the money if there's a lot of volatility in the market or an expensive stock, maybe coming up into earnings, something like that. If it's a stock that you're totally willing to hold the downside and you're more after the returns, then consider the at the monies or maybe slightly out of the monies. Okay, step number 2. Once we have our position on, you just simply need to monitor it. If you're using in the money or out of the money, remember that they decay faster in the first half of their life, not the second half. That's an at the money option. So if that's true, if you're selling these out of the monies, consider buying them back at the halfway point. So if you sell a 30-day, buy it back after 15 days, sell another 30-day, and buy that back after 15 days. And you will end up with a much higher return even though you've held the option for 30 days. So that's an important step to understand for covered calls. Now, another thing is, as we're monitoring it, if the stock is approaching that strike, then you can roll up and out. So if we have the $100 stock and we wrote the 105 call and the stock's now 104, or maybe even just above 105, it's trading at 106. Well, we can roll that one out. We can buy back our 105 and sell the 110 strike maybe a month or 60 days out. And we just keep looking further and further out until we can do this for a credit. And that way you won't have to spend any out-of-pocket money to do this roll. On the other hand, if the stock price is falling, then you can roll down or roll down and out. And we're going to roll down and out far enough to generate sufficient credits. And that can at least mitigate some of these losses. But if something has changed in the outlook, the reason that you bought this stock is no longer valid, I would just shut it down. Because now your entire thesis is wrong why you bought the stock. But as long as you like the stock, that's some of the risk that you're presumably willing to take. Then take it, but just mitigate it by rolling these options down. You can also consider buying puts. This is a strategy called a collar, and it will resemble a vertical spread. So that's something else. Maybe if you're coming up into an earnings period and you're trying to just get over the hump and you want to guard that downside, then you could sell that call, take some of that cash, and buy an out-of-the-money put. And then finally, in step 3, you're going to eventually get near expiration. And if the call is near worthless, then simply roll it. But you can also consider the rates of return and the hedge. So if the hedge isn't big enough prior to expiration, roll it then. But if you're willing to hold that downside, then maybe we can consider the rates of return. So for example, let's say this option is trading for 40 cents with 5 days to go. That's about 8 cents per day that it's going to decay. And yet if I roll it, I might get $2 for 30 days, which is 6 cents per day. So would I rather have 8 cents per day or 6 cents per day? Well, if I opt for the 8 cents per day, that's okay. Just recognize that I only have a 40-cent hedge going forward, whereas I could put myself into a $2 hedge. That's the trade-off. But again, if you're willing to hold that and you're just after the rates of return, I would continue holding this current one until these numbers flip. And eventually they will. And when that happens, then go ahead and roll it. However, let's say that our current option is trading for 20 cents with 5 days. Well, that's only 4 cents per day. And if I can roll it to something that's giving me 6 cents per day and giving me a bigger hedge, then it makes no sense at all to continue holding this option. You'll definitely want to roll it out at that time. So those are some of the basics that I would consider for writing calls. And I know the trader that posted this question said that she was fairly new to it, had been doing it, but kind of hadn't been doing it for a while and felt a little rusty. Those are the key points that I would focus on. But these are by no means all of the things that are going to come up in the decisions. But if something happens along the way, or if this doesn't answer all of your questions, please go ahead and post them in the forum and I will do my best to answer them. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the YouTube channel, Options A to Z's Facebook Trading Group, where you can find all of the archives of the videos in this trading forum. And you can find a link in the description below.